great. And Nick, obviously you can let people in after we've started already. So,
Correct. We can let people in after you've started, and I've left actually the ability to register for the event and get the link up until 10:30, so people can sign in late if someone's sharing it around.
okay, great. So let's give it 2 more minutes and then we'll get started. Some people also, like I see one of the agents on here, like they run a big team. I wonder if their entire
Right.
team is just watching it together as well.
Yeah. Yeah, that's I get people when I do my live podcast texting me photos of, 5 people together watching the same screen kind of thing.
Yeah, exactly.
Yeah, just to confirm, we send out reminder emails 2 days before, 2 hours before, and 10 minutes before, so everybody
Yeah.
should catch
Good.
up. All right, I'm gonna start letting people in. Break a leg, fellas.
All right,
All
we'll get
right.
things
Thanks, Nick.
started. Thanks, Nick. All right. Hello, everyone, and welcome to this month's webinar. We are very lucky to have Jonathan Miller. Again, we do this every month. We pick a different topic that we think is relevant to the real estate agent community. And again, we are very, very fortunate to have Jonathan Miller here today. I'm sure everyone on this call already knows Jonathan, but if not, Jonathan, if you want to take just 30 seconds or so and introduce yourself, and then we can get things started here.
Sure. I'm Jonathan Miller, co-founder and president of Miller Samuel Real Estate Appraisers. I'm the author of the Douglas Elliman Market Reports. I've been doing that for 31 years, which is kind of a long time. And I teach market analysis at Columbia for their Masters of Real Estate Development grad program. And I always have something to say.
That is for sure. And for those of you who don't know me, my name is Scott Nadler. I'm a residential mortgage broker and banker with Cross Country Mortgage. So Jonathan, let's get things started here. You and I spoke on Monday, and you had mentioned that nationally, the data is showing an increase in mortgage applications, and it's also showing an increase in all cash buyers. So
Yes.
can you go deeper into that for us and speak to what you're seeing relative to our market as well as what you're seeing in the,
Sure.
broader suburbs too?
Sure. So two sort of, ideas here. One is cash buyers and one is rising mortgage applications. We are seeing, according to the Mortgage Bankers Association, we're seeing applications rise nationally. And I think the reason is, and this is more theory than anything else, is that when I think about when the tariffs are announced in early April, that there was tremendous stock market volatility. Now, with the later announcements, there's really less volatility. And I think consumers, the uptick in applications that we're seeing in the region nationally is because the uncertainty is there's a certainty in all the uncertainty that we're seeing, and I think people are kind of tired of waiting. The other thing is that we saw in New York City and Manhattan specifically, a record market share of cash buyers. It was just shy of 70%. The long-term average, I have data going back about a little over a decade, and the average is right on the nose at about 50%, meaning 50% cash, 50% finance purchases. And now we're seeing about 70% cash. And we're seeing that same pattern like in South Florida, where I track about 14 housing markets we just published last week. And the average there is in the 60s, the mid 60s for the 14 markets, which is elevated. It's not a record, but it's elevated. And when you think about cash buyers, what they're doing, they tend to skew more wealthy or higher net worth or the higher price of the property. And they have alternative financing, that I don't know your business like you do, but I would think if someone has a wealth manager and they're worth $100 million and they want a mortgage, they're not paying 7% on a 30-year fixed. That's my wild guess.
Correct. Yeah, that is typically not our client.
Right.
Absolutely.
So what the way to think of cash used to be like, hey, I want to be the in front on a bidding war, for lack of. Now it's really just a way to navigate around higher mortgage rates. It's and it's it's not, that level of cash isn't permanent, but that's what we're seeing at the moment.
Yep. And we're going to talk about rates also. Inventory levels are starting to ultimately rise. What do you think it is causing that?
Right. So first of all, there is an impression that inventory is much, much higher across the whole country. And that is not true. Sort of the old saying, housing is local and mortgage rates are national. Not exactly, but it's sort of the idea. And what we're seeing is, Sunbelt markets like Texas and Florida, a lot more inventory, but even there, it's very nuanced. Like I cover, we just published in Palm Beach County and Broward County and Palm Beach County, and they're all different. But generally, the further south you go, I don't think it has anything to do with the heat, but in Florida, the more inventory there is. And I was for the last year saying that, like markets, I don't mean to go off on a tangent with Florida, but we're seeing inventory rise on the ocean side at sort of the same rate that we're seeing it on, maybe a little bit lower on the Gulf side, but not much lower. And in New York, we're seeing inventory, it never really was gutted. So inventory in Manhattan is just a hair over the long-term norm. It may feel like to some agents that inventory is generally rising, but like low single-digit rate, it's not surging. And I think brokers, when they're thinking about inventory, they're thinking, inventory feels low. Well, one of the reasons the numbers are not low, but there's still a lot of people that are pricing their listings as if it's 2021. And for those of you that have never heard me say this, housing prices in Manhattan for the last 8 years have largely been flat, moving sideways, a little bit up, a little bit down, but it's sort of a flat trend. We didn't see the explosion in pricing that, say, the Sunbelt did during the pandemic.
Now, those sellers who are sitting with a 3% rate right now, who have been on the sidelines, you're seeing some of those sellers ultimately listing. And so can you speak to that a bit as well?
Sure. I think, you're basically referring to the lock-in effect, the idea that, hey, I have a 3% mortgage. So, that's an asset now. And I'm going to hold on to that. And, because the prevailing rate is, just shy of 7% for a 30-year. And the reality is that inventory is rising, nationwide generally. And that's because life moves on. My sort of silly example for this is I always use this. I need a new storyline here, but the couple in 2022 that bought a one-bedroom condo and had triplets, right? They've been waiting for 3.5 years to get a bigger apartment or, moved somewhere because of a job relocation or whatever, and they're waiting for rates to fall. Uh, and so inventory, they own a property, they've been waiting, which has held back supply, but gradually we're seeing the lock-in effect ease. It's still there. But that's the story about lower sales levels across the country is more about, it's sort of like 50-50. It's half higher mortgage rates sort of restraining demand and half inventory shortage restraining demand. Like in the suburbs that surround New York City, it's somewhere in the neighborhood of, because inventory in the suburbs is dramatically tighter than it is in the city.
Right.
Inventory is, it's like 1 out of 3, 1 out of 2, 1 out of 3, 1 out of 4 buyers pays above ask. That's an inventory shortage. Even if inventory's up, inventory is still low. And so that's been the challenge of the market. So as inventory comes in, people have more options to buy, and there's fewer bidding wars, which I think is a much more sustainable market.
Would you say the city is acting more like a buyer's market and the suburbs maybe acting more like a seller's market?
I think that's fair. I would argue that uh, the suburbs are definitely a seller's market for sure. And I can generalize and say almost every market that my blind spot is New Jersey, but like Fairfield, Westchester, Nassau, is all super tight. Inventory is a shadow of, normal levels, like dramatically lower. In the city, I would describe it as maybe a little bit more of a buyer's market than a seller's market. I'd almost say it's a tie between the parties, somewhere in that range.
Yep. Let's talk about first-time home buyers. We work with a lot of first-time home buyers. I'm curious as to what the data is showing about first-time home buyers, and we are we are entering a time where we're going to see the largest transfer of wealth ever. So, and I would say the overwhelming majority of first-time home buyers that we work with are getting gifts from family. They
Yeah.
make good income, so they can qualify for the loan, but having enough money for the down payment and closing costs, they're getting help. Uh,
Yes.
can you speak to that? And I think it's also important for agents to think about, staying in touch with that client that they worked with a decade ago who may never buy a home ever again, because if they're sitting on a lot of wealth, that wealth has to go somewhere. And if that goes to their family and then they end up buying real estate, those are our ultimately,
Yeah, that's a legitimate opportunity for sure.
yeah, it's a major opportunity. Exactly.
Yeah, what's really been changing, first of all, just sort of a sidebar for context. This is national numbers from NAR, National Association of Realtors, are indicating that first-time buyers are about 24% of the sales, the home sales, and that is the lowest on record right now. The highest on record was double that, about 44%. And the long-term norm is about 38%.
When was
And
that 44%? Do you
uh,
have that there?
I I want to say it's about a decade ago. I don't recall the exact year, but it's been a while. And the other thing is that, and more importantly, your sort of reference to how parents are sort of helping their children become first-time home buyers is quite profound, because we're seeing, you know, when I first started in the 80s, parents were, or if they were helping their children, they buy a studio in Midtown Manhattan. They buy a small apartment as a starter. Maybe they were going to college in the city, and then that would become a pied-a-terre for the family. That was sort of the thinking. Now, it's much more common, at least in my on-the-ground view, is to see them buying like two-bedroom apartments for their parents, spending $2 to $4 million. That's very common, and the logic is that the baby boomers, being a baby boomer with four children who are all gainfully employed and have owned five houses, since they graduated college, between all of them, that parents are more interested in sort of basking in the glow of their family and enable them right here and now to to improve their living situation, and having kids and all that, like enhance that, as opposed to the kids waiting for them to pass and them getting an inheritance, right? And it's more like on the go type of oversight over their children to give them, and we see that, like it's a very significant change just in the last decade, I'd say. Even coming out of the pandemic, it's been there's been at least anecdotally, an acceleration in my observation of that behavior.
Mm-hmm. We talked about COVID. So in 2020, we have COVID. We see article after article stating that New York is done and everyone is leaving. Everyone
It's
went to
not only
Miami.
done, it's dead forever.
Dead forever.
That was the headline.
Exactly. 5 years later, what is the data showing you now?
Well, if we just look at the Element report that was published a couple of weeks ago on the second quarter, just looking at that, sales are rising, inventory is rising 3% nominally, it's not surging. Prices are rising. Inventory is, in relatively normal, like the way I measure normal. I mean, honestly, what is normal? I have no idea anymore what that word means. But if I look at the average of the last 10 second quarters, 10 years of second quarters, the second quarter inventory total is just a tad higher than the long term average, but it's within a rounding error. It's pretty close. We're not a market that is lousy with inventory, as I like to say, whereas maybe other areas, especially in the Sun Belt, you have submarkets that have a lot more supply than they did 3 or 4 or 5 years ago, before the pandemic, 6 years ago.
Mm-hmm. How do you feel about appreciation rates? Let's talk about Manhattan, and we can talk about Brooklyn, Queens, the suburbs.
Yeah.
What are you anticipating there? Also, I should mention, if anyone has a question and wants to put it into the chat, please feel free. I should have mentioned that earlier, but please.
Yeah, the way I think of it, first of all, and this is something, maybe it's a call to action for real estate agents, because from, I believe, just in the New York metro area, if you're having this conversation today, or we are having this conversation today, and then think about like 1 or 2 years from now, prices will be higher. I'm not saying dramatically higher, depends on where you are. And this is, sort of dovetailing in with your question, is that, there's very modest growth in the city. It's sort of maybe a hair above inflation in the last couple of quarters. But if you go to the suburbs, prices are rising, 7 to 11 or 12%, like way more. And why is that? Because they're having bidding wars still. That it is, inventory. One of the things, and this sounds really simplistic, But I always like to say that during the pandemic, we learned that when mortgage rates are too low, that inventory gets wiped off the face of the earth and housing becomes less affordable as a result. So, it's not like buyers are the only ones that benefit. Like the seller is aware that mortgage rates were at record lows and they price accordingly, right? And so inventory is sort of like this intangible blob that sort of floats around and gets uh, it needs time to sort of grow through the actions of the occupant of the real estate asset. So they become empty nesters. They want to relocate. They want to downsize. They want to increase the quality of their residence. They get relocated. They want to move. There's like a million reasons why people want to move. And the problem is that when rates fuel a lot of transactions, but that inventory, to become available, just takes a while to sort of percolate. And that's why, we're sitting here in 2025, mortgage rates are more than double what they were at the sort of the bottom of rates during the pandemic. Yet prices are higher, right? They're not correcting because inventory was depleted because of low rates, um, because of the demand was sort of off the chart. We had the biggest housing boom of the modern era during coming out of the pandemic.
So for that wannabe buyer who is telling us that they're waiting for rates to drop to 5.5%, we would say, be careful, because a lot of other people are also waiting for that same thing. And what is that going to do to the
Exactly. Yeah.
price?
I also, what I would say is, well, you need to be patient then, because barring some sort of black swan event like another COVID or something that blindsides you, that somehow devastates the economy and mortgage rates plummet. Aside from that, everything that in economic policy right now is seemingly inflationary or anti-rates falling. So
Mhm.
even if the Fed uh, cuts, like Goldman Sachs is predicting 3 cuts in the back half of 2025. Bank of America, I think, is 1 cut. Everybody's talking about cuts. Just because they're cuts, that doesn't mean mortgage rates fall. It's not directly connected.
Yeah,
Um,
short-term
and
rates versus long-term rates.
and I would bet that the odds of a meaningful drop in mortgage rates are limited.
Yeah.
And so I'm not sure what you're waiting for. I mean, I'm not sitting there, I'm not selling you. I'm just saying that when you have uncertainty, so think about what we have. We have the big, beautiful tax bill, which is, multi-trillion in debt added to the national deficit. That's inflationary. We have tariffs. Tariffs are a tax on Americans. That's inflationary. And we also have, like, sort of not a clear understanding of sort of the future direction of the economy, what strategies are. That is sort of anti-rate cut. So I would actually, and I'm not a trained economist, but I would be surprised if nothing else changes from what we know today, that we're going to see a rate cut that's going to influence mortgage rates lower this year.
Mhm.
It's more like, and I told you this before, and this is sort of silly, but there is a certainty to the lack of certainty in this economy. Our uncertainty has uncertainty.
Yeah.
And so it's sort of becoming a fixed thing, like waiting for the rainy day when things are, much cheaper. I think it's been 3.5 years since the Fed pivoted to causing the steepest ascent in mortgage rates. I don't think the Fed cutting now is going to really, there's too much inflation tension in the market to think about mortgage rates really falling. So, if you're thinking about moving or making a move, it just seems like a false premise to bank on that rates are going to be meaningfully lower, in the near term.
Yeah,
Maybe
and
I could be wrong. I don't, but just based on what we have in the persistent chaos in the economy and policy, it just seems unlikely.
yeah, I don't anticipate any changes for 2025. Um, and
There
when
might
you
be,
have a lot of
there's a better chance of rates falling in 2026. I just
agreed.
don't know if it's going to be meaningful as the economy sort of, as tariffs actually start hitting, which is over the next couple
There's
of
also a lot
months.
of this outdated modeling that is being
Yes.
used. When you have the jobs report for 2024, when they overestimated jobs by close to 900,000, you
I
realize that
feel
they're
like that's
using
a
outdated
I feel like
models.
that's a big mistake, right? That
Yeah.
that if that was closer to actual
Where
rate
would rates
policy, it would
be,
be different.
right?
Yeah,
Yeah, yeah, exactly. I
agreed.
want to talk about the rental market.
Sure.
You have, rents are obviously been going up as well. Can you speak to that?
Sure. We released 2 weeks ago our Manhattan. We do a monthly rental report on New York City covering Manhattan, Brooklyn, and sort of northwest region of Queens. And we saw record prices, record rents, what people are actually paying. And what's a little unusual about 2025 rather, is that normally we see price records hit in the summer as people are rushing to get in before Labor Day. That seems to be the pattern. I've tracked it empirically for years. And you can see, July and August are the months that the records tend to hit, more August than July. And that makes sense, right? That's when people are trying to, get situated and there's a rush. The records this year started in February, and every month since February through we're through June in our reporting. July hasn't ended yet, obviously, and every month was a record except for one of those months, and it was only $5 short of the all-time high at the time. So we're on this trajectory of sort of breaking records, and so when we think about July and August, which are seasonally when we're at peak of the annual sort of, a year for rents, I'm anticipating, record rents over the next month or two. And then your next question is to me, well, why is that happening? Why is it early? And I think the reason is because that rates are stuck. Initially, I think it was because of all the tariffs and the chaos in the financial markets that initially occurred, and so that uncertainty led to people that were camping out in the rental market waiting for rates to be lower, were just sort of staying put, right? And I think that's sort of the narrative about the rental market. It's not that when rents are high, prices on apartments are low. There's not necessarily an inverse relationship. They're not perfectly timed, but the idea is that rents can react immediately, um, whereas the sales market is sort of a slow and lumbering asset. Um, but what's interesting, and this is the part when you say, well, look, you're saying that rents are up because people are camping out and not buying, but we saw sales increase, right? They don't necessarily tell the same story, but what that tells you, and what we've seen in the data, is that the last 2 years we have a net migration uptick, meaning that there are more people coming into New York City than leaving. For the last 2 years, like the narrative of fleeing New York is sort of passe. I'm not sure what it'll be, in 2025, but I think that whole narrative is sort of past. I remember, and my class, my class tomorrow, I teach it, my Columbia class. I always show this slide of a New York Post headline that said, which you were sort of alluding to, that the New York City. The headline was "New York City is dead forever." This was during the pandemic, and sort of the source I tell my students is the source was written by a comedy club owner, right? So that's the first thing when you're trying to understand the housing market, really pay attention to the source. I had a class I took once on presenting information, and the professor said anything that doesn't have a source is a lie. Like, just be careful of it. And look at us now, like the market, there's inbound migration, and we have a net positive in the purchase market, despite usually a record rents comes at the expense of the purchase market, and we didn't see that this spring.
Right. All right, we are wrapping up. We're a little bit over. We're going to ask two more questions here, and then we'll be done. Jonathan, I want to put you on the spot a little bit with these last two here. With all the agents on this call right now, we just went through a lot of different data and a lot of different things that are happening in the market right now. What is the biggest takeaway that they should take away when speaking to buyers, and what should they be saying to their sellers right now?
So I think I think of it as well. If I think of I'll take the seller first. So the market, the way to think of it is that, and I think what many sellers do right now in the current market is make the mistake that they are sort of on a throne and are calling the shots. I'm not saying that New York City is a seller's market. I was saying it was kind of neutral. And that's because you can see it in transaction volume is modestly up. Prices are modestly up. We're not in the middle of some kind of housing boom like they have like this memory of like the pandemic frenzy where everything that wasn't bolted down was sold off. It's not that kind of market. It's improving, more activity, not a lot of inventory isn't low. It's remember that the sellers need to remember that the buyers are hampered by higher mortgage rates, right? Lending standards, credit is tight. Like they need somebody like yourself to walk them through because credit conditions are tight. Why? Because there's a lot of uncertainty, right? On the buy side, buyers are clearly thinking they're, at least in the city, that they have more power than they do. And they think that they're going to get a huge discount or whatever because mortgage rates are double than when they last looked at an apartment 10 years ago, and rates are double what they were or whatever. And it's like, no, that's not going to happen either. And so the gap between expectations of a buyer and a seller is that hole is sort of the lower level of sales activity that we're seeing nationwide, that sellers feel sort of stronger than they are and buyers think the market is weaker than it is. And that disconnect, the void between them, is lower sort of levels of sales activity. That's how I visualize it.
Last question here, and this is in the chat. Do you see rental prices as a leading indicator of the sale price?
So that's a great question. And I think the answer is, I'm going to really go out on a limb and say sometimes, because sometimes the connections don't make any rhyme or reason. So look at what's happening right now. We have rental prices have been flat, or no, I'm sorry, sales prices have been flat until the last couple of quarters where we're seeing a little bit of a rebound. And you could say, well, rents are, have been rising for a couple of years now at at least 3 years now at a pretty fast clip. So that eventually led to rising sale prices. My problem with that is during the pandemic, rental prices fell 23, 24% like overnight with the lockdown and the pandemic, and housing prices remained flat. So I don't see there being it kind of works when it works. And maybe in local markets, there's more of a subtle explanation for that. But just as a general rule, it's not that I throw that concept out, but I don't place a lot of weight on it.
Gotcha. And with that, I think that wraps up our webinar. Jonathan, thank you so much. We could do this I could speak to you for hours. I
have a
I
5-hour
spoken to
cap
you for hours.
on.
Yeah, we could definitely do a 5-hour class at some point. So thank you very much.
My
To all
pleasure.
the attendees, thank you for coming. And we will do this again soon. So Jonathan, thank you so much.
You bet, Scott. My pleasure.
Take care.